Welcome to Turning Hard Times to Good Times. I am your host, Jay Taylor. I'm speaking to you from New York City on this, the 4th day of June, 2019. And as I always like to remind you, I'm the author of a newsletter called Jay Taylor's Gold, Energy, and Tech Stocks. And you can subscribe to my newsletter, which features a lot of very exciting junior gold stocks. You can sign up for that by going to miningstocks.com, or you can call our office here in New York City during normal work hours at 718-457-1426, 718-457-1426. I always like to put in a plug for my friend Chen Lin's letter as well. What is Chen buying? What is Chen selling? And for that, you go to chenpicks.com, chenpicks.com. Biotechs, energy stocks, and gold and silver stocks. Those are the areas that Chen focuses on, and he's done very well over his career in those fields. And, of course, Michael Oliver as well, olivermsa.com. We'll be talking to Michael in just a minute. I do want to thank each of you for listening to the show, making it one of the more listened to shows on the Voice America Business Channel. And I want to invite you to keep your questions and comments coming along to questionsfortaylor@gmail.com. Questions, the number 4, taylor@gmail.com. And we do want to thank our sponsors for making the show economically viable. Without them, there would be no show. Today's sponsors, Klondike Gold, Novo Resources, RN Resources, and Strike Point Gold. I've titled today's show, Will Modern Monetary Theory, or MMT for short, Ignite Gold? Richard Maybury, Ivan Bebek, and Michael Oliver are with me today. Following the 2008-2009 financial crisis, Fed Chairman Ben Bernanke began to implement modern monetary theory, resulting in zero and even negative interest rates in some countries. With a modest recovery in place now, but with debt continuing to grow exponentially against linear GDP growth at best, the Fed has stopped MMT for now. But in preparation for the next crisis, it is ready to pile trillions more of debt-manufactured dollars into the global economy. In fact, just today, Fed Chairman Powell has hinted at rate cuts if trade tensions continue to rise. And some professionals on Wall Street are even talking about as many as 3 more rate cuts this year yet, all part of MMT. Well, we will ask Richard Maybury during the second half of today's show what impact that might have on our markets, the ones that we watch most closely, what impacts it might have on our society, and in general, how it might impact Americans. Ivan Bebek, who is the executive chairman of RN Resources, will talk to us about that company's exploration efforts in Peru, as well as the Nunavut, a very exciting exploration project up far north that is looking very promising. And we'll also ask him about some other things that are going on. Very interesting development, it seems, in British Columbia with its Homestake project up there. So we'll talk to Ivan right after the first commercial break. But right now, I'm happy to tell you that Michael Oliver is with me once again. Thanks for joining me, Michael.
Hi, Jay. Good to be back.
Always good to have you with me, and it's always good to tell our listeners, and they should really pay close attention. It's olivermsa.com, olivermsa.com. I know you'll be listening to what Michael has to say about the markets, but if you really want to take advantage of what Michael has to say and his good work over many years of experience, you might want to consider subscribing to his newsletter at olivermsa.com, and especially you gold bugs might want to take advantage of his lower price precious metals newsletter, which is absolutely excellent and spot on. Michael, in a note to me this morning, you suggested that I should keep a close eye on the dollar in anticipation of a dollar decline. Well, it seems to me everybody's pretty complacent about the dollar. There doesn't seem to be any likelihood of a dollar decline, but are you seeing something a little different, something that's warning you that the dollar could be vulnerable in the near term? Do I have that right?
Yes, you do. The dollar has actually, there was an article in the Journal the other day about the T-bond market and how the firm dollar is one of the justifications for foreigners buying the T-bonds and so forth and so on. I think it's flight to safety primarily, but no doubt if you have a firm dollar and you're a foreign investor and you buy U.S. stocks or U.S. government bonds, you're reinforced by what they call a firm dollar. In fact, the dollar's firm, all firm, right now it's trading about where it traded 11 months ago. In fact, the last August high, which is right about 97 on the dollar index, and draw a line sideways, today's low is 97. So, yeah, it's firm because it's boring. It's caught in a very narrow range with a tone that feels steady. Our momentum work says it's highly likely to break down out of this zone of slightly upward congestion that's been prevailing for, like I said, 10, 11 months. And I think it's going to shock people because right now the dollar and its inverse, the euro, are so boring in terms of volatility and lack of real movement that everybody's ignoring it. I mean, you're seeing volatility, aggressive upside in T-bonds for obvious reasons. You're seeing now aggressive upside in gold for, again, we think obvious reasons. And you're seeing extreme volatility in the stock market down, and now you're having what I consider a flare rally that's likely to fail by next week. But you're getting volatility, getting heads turned.
Yeah.
The dollar is boring. And so I think that's where the next ambush is going to come, is when the dollar wakes up and breaks down. We've got some specific numbers that we inform our subscribers of that aren't far below the current market. And we think that when those numbers are triggered, and we think they will be probably next week, downside will pick up noticeably. And that will shock a lot of people because there is an overwhelming opinion globally that the dollar is firm and safe place to be, and all kinds of assumptions can be based on that assumption.
Sure.
We think that's about to be overturned. Of course, that would help gold. But actually, if you stand back and look at it, since August of last year when the dollar was 97 and it's still there, in other words, it's been steady to up, let's call it, gold has gained huge ground without any help from the dollar. Imagine what happens if the dollar breaks. Gives it a little more wind at its back, and I think probably a lot of wind at its back of gold. So anyway, watch the dollar. It's boring, but it's not.
Yeah. Well, Michael, let me ask you, what kind of a decline do you see might be possible for the dollar over the next 6 months?
Well, about the next, we think that by the end of the year it's possible, and we're not aggressively assertive on this, that we think the dollar could take out the low it made in early 2018. The dollar index then made a low at 88.25. So we're trading around 97. So we're talking about a 10% drop to take that out. Now, in the dollar, that's a big move. Now, the stock market or something like that, it's not a big move. But for the dollar index or the euro inverted, that's a large, earth-shaking move. And we think it's entirely reasonable that that's where it's headed, to take out that 2018 low. And just getting there is a big deal.
Well, could that be
a sleepy market? Go ahead.
Yeah, I would presume that might be bearish for bonds then.
Well, it might be, but I think the bonds are overwhelmingly buoyed by simply flight to safety. And if we're right on the stock market, and we're major negative, we could get very, very negative for a rapid down move. If the S&P dropped about 5% from here, and we've got some other numbers and other indices, we've asserted that the 1929 situation, technically speaking, from our momentum vantage point, the 1987 situation were very similar from a momentum perspective long term. Right now, the S&P has the same metrics underneath it, and they look vulnerable and they look like they're going to be broken. And if that occurs, therefore, any movement in the stock market to the downside could be over very quickly, as opposed to a protracted multi-year thing, although that may occur too, but it could begin with a huge whoosh. And we've got numbers specified, but I think that kind of movement, the bonds won't care what the dollar's doing, because the bonds will be sought after by everybody, and so will gold.
Well, I would think so.
Yes.
Yeah, I would think so. If the dollar loses, say, 10% of its value, then right away that sort of knocks the wind out of the Treasury market to an extent, I would think. And then there might be more of an inclination to move some money into gold.
Yes, I think so. And if you notice the tone in gold, we of course viewed this entire intermediate trend pullback that occurred since the Jan-Feb highs in gold, up at the 1344 was the high in February, as a more or less benign waste of time, that it was one of the most mild pullbacks ever since gold got up into the mid-1300s in 2016, 2017, 18. This was the mildest pullback over a protracted period of time. It indicated to us that the bidding under this market, under the gold market, was firmer than it's ever been before once it got up into the mid-1300s resistance. It's our view that that level at 1340, which we got to in February, will probably be seen soon. And when it is, don't hold your breath and look for a pullback. It's likely to explode. Now, this may have implications. If we're right on that, it may have implications about inverse action in the S&P and also the speed of the S&P.
Yeah.
Anyway, but watch the dollar. I think it's the one piece of the puzzle that hasn't come into play, and I think people will be ambushed and surprised by the direction that it takes.
People aren't paying attention. Well, Michael, just with a minute left here yet then, I would think a declining dollar would be bullish for some of the other commodities as well, at least in terms of a dollar denomination, right? So I would think it might be bullish for silver. What about oil?
Oh, yes. No, I think oil is still linked to the S&P now. I think copper to some extent is as well. Our view is that silver and gold miners will vastly outperform gold going forward. Over the last year or two, while we've wavered in the mid-1300s and 1200s in gold, they've wandered all the way back down close to their bare lows of 2015-16. But they look like they're slingshots, and that when gold gains that extra percent above today's high and hits 1340 again. Watch silver and GDX, for example. They're likely to go up in percentages double that of gold.
Well, where do you think just looking out into the future, if we break through 1340, 1350, or whatever you need to break through, what might we anticipate on the upside?
I think gold could go to the 1520 area before it even takes a breath.
Wow.
In other words, if you touch 1340, I think the next move, that's not a big percent. That's 15-16% or so.
Yeah.
Now, silver will do better than that, so will GDX. But I think that could happen in like a whoosh within weeks before you even pause to take your breath on gold. Again, the issue is going that extra percent above today's high. But we think that'll happen because our momentum indicators have already effectively accomplished that. It's merely a price issue now.
Interesting.
And I think the world is looking at that price level because there's a trend line on gold going back 5 years across all these flat highs. And every asset manager in the world can see that line, and he's got to be concerned that if it hits there and goes through, he better be part of it.
Yeah, interesting. Well, it could be, I'll tell you, we've been waiting a long time. It's been a long time since we've seen the highs in gold back in 2011. And then the wretched decline and then sort of a base building period here. If we get that kind of a move, it will be more than welcome for gold shares, no doubt about that. But I would say we've certainly been waiting for it. It's not as if we've been sitting in Fat City here. So, Michael, thank you very much.
Thank you, Jay.
Your comments are always welcome.